Welcome to our part 3 of the financial literacy, investment instruments and risk management. We are going to focus on risk management. First, we need to understand to answer the following questions as a student. What is a risk? What is risk management and how do we manage these risks? A risk is a chance that the actual return will be different from the expected. When you expect something but it comes out different from what you expected, that is all we call a risk. As we said, all investments involve risks. Stock prices can fluctuate widely, and even high quality bonds can lose value if interest rates or inflation change. So that is what we call a risk. What then is risk management? It is a process that identifies the loss exposures faced by an investment and select the most appropriate techniques for treating such exposures. So risk management in simple involves identifying the risks, and then you select the most appropriate technique to treat the risk itself. We have the risk management process, the process by which we are able to manage these risks. First of all, the first is to identify the risk. The first step is to identify what is the risk in the investment. There are many types of investment risks. It can be either be market risk, interest rate risk, purchasing power risk, or regulation risk, international risk, or liquidity risks. But the first step is to identify which risk is it. Is it market risk? Is it interest rate risk? Is it liquidity risk? If so, let's first discuss these risks. Market risk is a risk that allows the overall market or an asset class to decline, affecting the value of your investment. For example, a stock market crashes or a significant drop in real estate prices. That is market risk. It is where the stock market will either drop or rise within an expected period. We have interest rate risk. It's the risk that changes in interest rate. It will impact your investments. For example, when interest rates rise, the value of your fixed income securities like bonds decrease. So when your interest rises, when the interest rise, the bonds decrease in interest. Let's go to the next is price risk. This is the risk that the price of a specific asset or security will fluctuate, affecting the value of the investment. For example, the price of a commodity such as oil, gold, they can be volatile and impact the value of investment linked to that commodity. In other words, the price will change, which then will affect the value of the investment itself, such as oil and gold. We have purchasing power risk. This is the risk that the real value of investment will decrease due to inflation, reducing the purchasing power. For example, if you have cash savings and the inflation rate is high, when you have cash and the inflation is high than the interest rate on your savings, then your purchasing power will decrease over time or will erode over time. We have regulation risk. This is the risk that changes in laws or regulations of these government policies affects the performance of your investments. For example, tax policies or industry regulations, it can affect the profitability of and stock prices of companies. If you invested in a stock, the tax or the regulations put are going to affect investment. We have international risk. This is the risk associated with investing in foreign markets. When you want to invest internationally, there are risks since there is currency fluctuations, maybe there is political instability, maybe the economic conditions of the country is not favorable. So we have, for example, investing in a country with a history of political unrest or economic volatility. What do you expect? Your investments will be affected by this, and there will be now international risk since the country you're going to invest into has political unrest or economic volatility. We also have liquidity risk. This is the risk that an investment cannot easily be converted into cash. We said liquidity is the ability where you can convert your cash, your investment into cash easily. So the liquidity risk involves that your investment cannot be easily converted into cash without significant loss in value. For example, investing in illiquid assets such as real estate or venture capital funds. This can make it challenging for your access to this venture or real estate are illiquid. Thus, that is a risk. Let's go to step number 2. You have to analyze the risk. How do you analyze this risk? If they take place, you'll have to be what will be the consequences of the risk? Choose the risk to focus on in terms of the loss, the financial loss. You have to analyze and know which investments brings a higher loss in terms of financial or the impact, the severity of the impact. You have to rank which one has a potential high severity of impact. Then you have to, that is how you analyze. We have evaluating the risk in terms of possibility of happening or the impact on the project. You have to evaluate the risk and identify the useful solutions for the risk so that you can help treat the risk. At number 4, we have treat the risk itself. This involves solving or at least reducing the risk. After you have analyzed, then evaluated, you'll have known how to treat it. Is it by diversification or by hedging? We have monitor the risk. After identifying the risk, analyzing it, evaluating the risk, and treating the risk, you have to monitor the risk and ensure mitigations are put in place so that the risk does not reoccur again. We have risk management of investment. How do we manage these risks? At number 1, according to our coursework, we have diversify your assets. In other words, do not put all your eggs in one basket. You have to, as you can see, there is a basket that involves all types of investment. You should not put your eggs in one basket or invest in one asset. Invest in different categories of investments. Diversification reduces risk by spreading your investments across various assets. If some investments perform poorly, others may do well. You never know. Balancing the overall return. So you put your eggs in different baskets. Others may spoil, others may be well, which will be being a balance. Seeing overall return. What are the benefits of this diversification? It helps minimize the risk or reduce the magnitude of possible loss. By spreading the risk into different various classes, you are mitigating or reducing the risk. At number 2, we have hedging. It is the process of controlling the possibility of a loss. A risk management strategy used in offsetting The probability of a loss from fluctuations in the prices of commodities or currencies or securities. The most common way of hedging an instrument is through derivatives. Investing in derivatives. By investing in derivatives, you have hedged or controlled the loss of your investment. At number 3, we have asset allocation. You have to balance different types of investment according to risk tolerance. As we know, stocks have high risks and others have lower risks. So in this asset allocation, you have to balance your investments according to the risks that your asset has. We have also insurance. Insurance involves products like health, life, auto, or homeowners, renters insurance. This is to protect you as an investor or individual from financial loss due to unexpected events. You can insure your asset. As an investor, you've invested, insure in that investment because it will protect you against major financial losses. Evaluating coverage needs and comparing policies is important. So you should always insure your investment. Thank you. That's the end of our lesson. Hope you enjoyed and you have understood. For any questions, please feel free to pinpoint them. Thank you very much.